This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today has good intentions. He knows that finance, modern finance, helps to make the trains run on time, so to speak. Modern finance underlies all of us, all of what we do every damn day. But where's the virtue? Is modern finance really helping us all as much as it could? Or is there a dark side? A dark side where the biggest banks are front-running trades. The biggest banks are trading high-frequency stuff to just mint money while the little guy doesn't get a leg up. So is there a framework? Is there a different way to look at finance that can perhaps help society in a more holistic way? Now, look, you might be thinking, no way, it's dog-eat-dog, capitalist world. That's true, or at least it's been true. But is it sustainable? Can we keep going there? Do we need a new perspective? Do we need a new conversation? My guest today, JC Swaan, dives straight into the various issues of finance, and more specifically, this conflicted industry of finance. And where's the virtue? I really enjoy these conversations today. Because when everyone is just focused on the next buck, the next can I sell $1? Where's the happiness? Where's the goodness? Is this what we really want? Without any further delay, let's jump right into my conversation today with JC Swaan. So I'm taking my mind back to 1995, Netscape goes public. The world changes. A couple years later, early 2000, dot-com crash, fall of 2002, the NASDAQ hits minus 77%. Boom, as we all learned in the Big Short film, we then had a real estate jump. And then all of a sudden we get up to 07, 08, 09. We get to March of 09, stocks are at lows, real estate's at lows. I can think back to the film and the Steve Carell character, who really seemed to be the voice of reason, the voice of like, what in the blazes is going on? This is just, I'm speaking for him, but he must have been thinking, gosh, we know this is wrong. What are we doing? And the scene where he's down at a dance club in Miami and the dancer says she owns 5 houses or something crazy and hasn't paid a payment. And he just has that look on his face. That was, let's say that we put a pin in it, March of 09, boom, we had another run up until COVID year. For all of those lessons that you would have thought we should have been learning about doing things the right way coming out of the Great Recession, did we learn anything?
I mean, there are a number of factors at play here. I think one of the biggest challenges is that it's not just behavioral, but there have been structural changes over the past few decades that have really affected the industry and in some ways have moved it away from its client-serving mission and from its singular focus on supporting the real economy. And we also have a short memory.
Where does that leave us? Because I know you really see that period coming out of the Great Recession as a potential flip or a switch, or I'm not sure if you see it necessarily for good or bad. And of course, I think it goes back longer than that, as you just state. It really does look like not only are the institutions, the JP Morgans, the Goldman Sachs, on their merry way of producing uninterrupted daily positive returns for probably years, the average American, as long as they've got a house and they've got some stocks and a pension plan or whatnot, they're happy with all the stuff the Fed's doing. And it seems like where we should be having a conversation about perhaps something to do with right and wrong, we don't go there, do we really? It seems very like, okay, as long as everyone's happy and the money looks like it's rolling, regardless of how we got there, let's let it roll.
Yeah. I mean, the challenge is that if you look at the finance industry as a whole, there are a lot of issues regarding cognitive biases. You have a lot of folks in finance that just focus on their self interest without being aware of the fact that some of their actions have consequences on society. That's part of the focus that I wanted to bring to the study.
I hear what you're saying, but it does look like that. I mean, okay, big picture wise, if we were to look at the finance industry as a whole, what percentage, and this might be a very difficult, impossible question to answer, what percentage of the industry is actually looking at something like virtue when it comes to their employment with Goldman Sachs or JP Morgan or just the average investor? It seems like virtue is pretty far down on the list. It seems like profit maximization, regardless of how we get there, is where everyone is focused.
I think that's right. I mean, people are focused on their self interest, and that's totally fine. The challenge is when you pursue your self interest without being conscious of the unintended consequences of some of your decisions. I mean, the challenge with finance, probably more than other industries, is that finance is seen as an immoral field. And there's this sense that as long as you pursue your own self interest, then you're going to maximize the interests of everyone else. What is good for Goldman Sachs or Citadel is meant to be good for the rest of the country. My sense is that that is true for most of finance, but it's not true for all of finance. And because of all various changes over the last few decades, to your point about what's the part of finance that is focused on virtue or their impact in society, the part of finance that has become disassociated with, in some ways, serving clients and also focused on a singular focus on supporting the real economy, that part, I think, is the majority of finance, but there's another part that has grown and that leads to things like the global financial crisis.
Okay, but if we talk about servicing clients and I look at the rise of passive index funds, sure, the average person out there might know that the managing partners at Goldman Sachs are doing quite well and a lot better than they are with their 401k. But if somebody looks at March of 2009 until early 2020, I mean, if they've got a passive index fund, regardless of how much Goldman Sachs is making, aren't most people not really worried about their client service? Don't they look at all those returns under two presidents and say, oh, that looks pretty good to me?
Absolutely. My underlying assumption, the underlying premise here is that finance is a force for good in society. It's central to the way an economy works. It has many, many indirect positive effects on an economy by boosting growth, promotes entrepreneurship, it accelerates the rate of innovation, and so on. But there are ways in which there are financial activities that end up boosting the economy in ways that are unsustainable. And that's the challenge. In the run up to the global financial crisis, a lot of finance swerved into areas like providing ninja loans to folks that had no income and no assets. And those are the kind of things that they have their own logic, but eventually they end up hurting society.
If I can think back to that time period, and this is not a criticism of the players I'm about to mention, but I think it's factual. I can think back to that time period, and Wells Fargo, I believe, was a significant holding of Berkshire Hathaway. And I believe Mr. Buffett held them out as, wow, they were just the cat's meow. Once the dust settled post March of 2009, we found out that Wells Fargo was not the cat's meow. There were a lot of things going on, perhaps hinting at some of the areas that you're talking about. Is there any examples you might want to share with specifically? I mean, I know some of this is historical and perhaps people have forgotten and whatnot, but is there anything you might want to share, like as an example with Wells Fargo that we found out that kind of gets right to your point about going in the wrong direction?
Yeah, I mean, Wells Fargo is a fascinating example in my mind. To your point, this is a commercial bank that was portraying itself as having deep roots in its communities. And in fact, I'm very interested in understanding role models, ethical role models in the industry. For a long time, I was studying John Stumpf, the CEO of Wells Fargo in the run-up to the global financial crisis, as an ethical role model. I mean, this is a guy that had an incredible story and that kept talking about serving his local community. And then you have this enormous scandal. They basically created 3.5 million fake accounts. It was absolutely shocking. It symbolizes the extent to which the industry or part of the industry has deviated away from prioritizing its customers' interests. And my sense, looking at this particular case, is that the factors at play are basically industry-wide challenges. The fact that the industry has become a minefield of conflicts of interest, and I think a lot of it is derived from the fact that the large financial institutions became public starting in the early 70s. The fact that they're publicly listed creates attention. If you're Wells Fargo, you have this relentless pressure to deliver short-term results, and that nudges you away from the kind of patient, solicitous handling of customers that is critical to foster long-term relationships. In their particular case, they did something interesting. They were trying to sell multiple financial products to their customers, cross-selling. The reality is cross-selling, it's not a nefarious goal. In fact, I remember I spent some time in management consulting. We did a lot of these studies. I mean, this idea that you're trying to anchor everyone through the bank on a set of goals that you can link to value creation. But the problem is that one, to the extent that you link, you're obsessively focused on short-term value creation, then that can diverge from serving your customers in a way that's really consistent with your customers' interests. And two, Wells Fargo, they really stood out in the way that they were uniquely aggressive in their cross-selling targets and unrealistic. There was something about their culture. Then on top of that, this is not an issue that is solely about Wells Fargo. The industry is rife with cognitive biases. It's fertile grounds for cognitive biases. Those often prevent the exercise of independent judgment. And whether it's bounded awareness or motivated blindness, and there are all sorts of examples where when you go into the case of Wells Fargo, where you can tell that a lot of these were at play.
I was thinking, as we dig into your topic, and you probably have looked at this a lot more than I have, but you would think during an election cycle, a presidential election cycle, if we were really all having an honest conversation, I can think of two things specifically coming from finance that would be on the table. Because given that, let's say 50% of America receives some type of welfare benefit, the fact that we have payday loan sharking and the fact that we have basically high rate credit cards that are both of those things specifically targeted to folks that can never pay these things off. They are one of the biggest profit centers for some of our most famous banks. But I think since those audiences probably are not so savvy as to what the big banks are doing, they don't really have a voice. On the other side of the coin, the other folks don't really want to upset that apple cart, right?
Yeah, it's a really important discussion. What's interesting is that a lot of the focus of academic research has moved in that area because prior to the global financial crisis, a lot of research was about how finance is a force for good in society, which is true. But since then, there's been a ton of soul searching, and you see that the academic research has pivoted towards understanding ways in which parts of finance take advantage of the most vulnerable folks in society. And to your point, I mean, credit cards is one of the culprits. One thing that's fascinating is that you see that very typically the most complicated retail products are often targeted at the folks who are least able to understand them. So presumably, you and I would never get pitched these type of products, but it's often the folks who are not going to be able to delve into the dynamics, the underlying dynamics of these products that get pitched these products. And yeah, it's an important part of the conversation to be had.
Let's jump into a name that you brought up earlier. I think you brought it up before me, Goldman Sachs. I don't know much about Goldman Sachs, honestly. I know they're a pretty secretive outfit. I think unless you're on the inside, you don't really know too much. But there's this famous quote, and you quoted in your book, and a lot of people listening to this show will know it. Goldman Sachs gets referred to as the vampire squid wrapped around the face of humanity. And a lot of people might not even understand what that means. You probably have to have a little bit of a finance background to get that whole point. But now, on the flip side, if I was to take Goldman Sachs' side, I would say, okay, aggressive folks putting their money at risk, taking chances. They are serving their clients. They clearly have lots of clients. I assume a lot of their clients love their work. Give some history to that quote. Give some perspective on Goldman Sachs, good and bad.
First of all, Goldman Sachs is an incredibly sophisticated and thoughtful institution. A lot of my students end up going to work there. There's an interesting arc, I think, to the outside perspective on that firm, because historically, it's been a beacon of ethical behavior on Wall Street. I mean, if you go back to the early days, but particularly in the early part of the 20th century, you had all sorts of people from Goldman that ended up working for the government, and that has accelerated. It's imbued with the sense of public service. In fact, a lot of people have referred over the years to government Sachs just because of the number of folks that have gone from the Clinton administration, Bush administration, and so on. The most interesting character historically, I think, is perhaps John Whitehead. John Whitehead was the co-senior partner in the mid-70s to the mid-80s with John Weinberg. In some ways, he epitomizes this view of Goldman Sachs as a very thoughtful firm. He created these business principles. I think it was originally 12, now it's 14. And the point is that the first principle was you serve your customers and prioritize their interests first. And there are all sorts of ways in which the firm seemed to actually do this in practice. And so they actually push back against all sorts of activities that might have been profitable, but they decided were not in the best interest of their own clients. And then, of course, over the years, there seems to have been a drift, at least in terms of the way the firm has been portrayed in the popular press. And this is something that we've discussed at length in my seminar. John Whitehead, for many years, so I teach in a seminar on ethics and finance, and John Whitehead was one of the folks who came several years to discuss these dynamics. There are a number of things that changed, and all these are, in some ways, Goldman Sachs is a proxy for the industry as a whole. Goldman was the last of the firms to go public. Donaldson, Lufkin, Jeanret started in 1970, and they resisted until 1998, but that created all sorts of conflicts of interest. And then secondly, you see a business that has moved away on balance from long-term relationship business to one that's more about transaction, one that's more market-based. And then you see examples like Abacus. And Abacus has been well documented as collateralized debt obligation that was sold to clients that didn't know that the folks on the short side, John Paulson, had essentially picked most of the underlying mortgages that he wanted to short. And that came to light through a lot of public scrutiny, including by Congress. But my sense is that since then, there's been a reckoning, and that's been true not just at Goldman Sachs, but across the industry, and a sense that the bar needs to be higher, but also that finance professionals need to be more thoughtful about their impact on society. And there are ways in which a firm like Goldman Sachs can be incredibly successful at serving its clients. But here's a conundrum, is that you can be really good at serving your clients and put your clients' interests first, and yet you can hurt society because you're doing so by extracting value from society. That's one of the issues that all of these firms are, I think, increasingly grappling with. The truth is, my sense is from the outside, Goldman Sachs and a lot of other investment banks have done a ton of efforts to try to remedy this. And during the pandemic, you can see how they worked incredibly hard to try to be at the forefront of this. There were a lot of criticisms for how some of the banks prioritized their own clients in the way they extended the small business loans. But by and large, I mean, Goldman Sachs, for instance, put a lot of capital at work for local communities and small businesses. And it feels like in the arc of the evolution, there's a movement towards being more conscious of their role in society.
What would you say to the individual out there who has a memory of the fall of 2008, has a memory of assorted banks dropping like flies, and that magically somebody jumped in, a magic hand jumped in and saved Goldman Sachs and saved Morgan Stanley? That person that has that memory of fall of '08 says to themselves, well, gosh, maybe they should be showing a little more virtue because they were given a gift. They were given a lifeline. That makes an interesting conundrum right there is, do we have market forces still, especially when you look at the Fed's operations of the last 20 years? And I can still remember we get this huge run up in the NASDAQ in 1999. So then the Fed starts pushing rates up to try and pop the bubble. But of course, once they pop the bubble, we're back to the Big Short story. We know what happened next. And then essentially the same thing was repeated. What do you think about that, though, in terms of, I think it'd be a fair opinion for someone to say that if the magic hand did not step in, that Goldman Sachs and Morgan Stanley would have ceased to exist in the fall of 2008.
Yeah, that's absolutely right. There's something unfair about the fact that the public essentially saves large companies, and that was the case in 2008, and to some extent it's been the case this year as well, solely because of their size and the way that they're interconnected the economy. As a result, you had banks that benefited dramatically from a lot of risk taking. They got the benefits of the upside, but then all of the downside, in a sense, was socialized and was borne by the public.
Let me shift you slightly to something very academic, but also finance. And I had to go really quick today to check out Wikipedia, and I wanted to look at the size of endowments. Harvard, 40 billion, Yale, 30 billion, Stanford, 28 billion, MIT, 18 billion. These are huge numbers for 4 schools, massive numbers. And here we are having a conversation where we want to get at the idea of virtue. And I can only imagine that near those institutions with that kind of money in the bank, and I'm guessing it's money in the bank that has never gone down, probably it's a straight line up, essentially. I could be wrong, but I'm guessing that it's pretty much a straight line up. But here we want to think about doing the right thing and whatnot. How many of these communities that these universities are in with these massive piles of cash have got homeless folks and people that have no money surrounding them? It really does seem like an interesting thing. And look, if I happen to have been the person that started Harvard and this endowment process existed and our school was the number one and super successful and the endowment kept getting larger, I don't think I would necessarily look in the mirror and say I'm a bad person. And I'm not trying to say Harvard is. Because on the flip side, I can look at someone like Jeff Bezos and I can say, my gosh, round of applause for creating all this wealth. But on the flip side, when you start to be one guy with 175 billion, you see where I'm going here. It's a really interesting intersection where you start to have so much capital in the hands of so few when so many people don't have anything.
Yeah, it's a proxy for rising inequality in society in the sense that you see a lot of these industries and sectors where it's a winner-take-all dynamic. I think that's been the case in higher education. Now, the difference is places like Princeton have a public mission and they're obsessed with the public mission. And so they use the endowment money to fund research, but also to fund an enormous number of their students. And one of the things that, I'll mention that Princeton has done that I think is very inspiring is that they've taken the lead over the last 15 years in pushing really hard to get folks that never would have considered not only Princeton, but that are new to the college experience in the sense that we track pretty closely the number of first-year undergrads that come who are the first in their families to go to college. We also track, of course, the number of folks that are eligible for Pell Grants and all that. And you find that these numbers have risen very significantly over the years, so much so that campus has changed. The dynamics on campus have changed over the last 15 years. But your point is absolutely correct that there is real concern that the sector is skewed so heavily towards the winners. And that raises, one, it raises the bar dramatically for the winners to truly serve society. And two, it certainly elicits a lot more need for figuring out how to remedy this. because the inequality you're seeing is just unsustainable.
Well, yeah. And what's so interesting about it, too, is I would not want to be sitting here and telling Jeff Bezos in the early 1990s, don't put all of your blood, sweat, and tears in it. Don't put all your money in it. Don't take those risks. Don't take those chances. Because I can tell you right now, there's a gazillion people that love their Amazon, including my father, who orders way too much stuff every day, I think. Winner take all is the incentive system that gets you the innovation. It gets you the creation. But I guess we're at this unique point in time in history where you have that process, you need that process, but then you get to a point where Jeff is worth 175 billion and rational people, and perhaps even himself, rational people start to say, okay, what's the number? Is it okay for Jeff to be worth $1 trillion?
Yeah, there's something wrong about the system because, for sure, on one hand, we should absolutely celebrate Jeff Bezos. I mean, it's an extraordinary achievement and it creates an enormous amount of motivation for others to follow that path. And that's what makes our economy, our society so exciting, is the spirit of entrepreneurship and the ability to create wealth. By the same token, this idea that you can have so much disparity between the top 0.1% and the rest of society is problematic and unsustainable. And the reality is that financial system has an important role to play in this because all of this has been also facilitated by the capital markets, which are a force for good, but also can exacerbate these dynamics.
Why is it unsustainable? Because so far, going back to the dot-com era, coming out of it, getting recovered March of 2009, Amazon's cruising. What makes, for example, an Amazon unsustainable? It sure looks like to me they will put every small business out of business. And I don't see how that can be stopped. How is it unsustainable? I'm just curious your perspective.
It's unsustainable because there's a point at which there's too much domination and it stifles competition. I think the logic of competition allows Amazon to get where it is, but I do think that to the extent that they crush various industries, there's a point at which it becomes incredibly difficult for small businesses to compete against them. That's unhealthy in a sense. And so that's why I have all sorts of regulations that try to look into these market dynamics. And eventually, you need to think hard about whether you should allow any one company to dominate so much of the market for the health of competitive dynamics.
You talk about your young students that would perhaps be joining some of these investment banks. They are entering, here you are, you're thinking about ethics, you're thinking about virtue. And here these young students are entering places like JP Morgan and Goldman Sachs, existing structures, very codified existing structures that make a lot of money, have been around, and they're entering as low man on the totem pole, so to speak. And then there's a set of incentives. You join one of these operations, the deal is known. How can I, because I know you want to be optimistic, and I know that's the perspective that you're bringing. That's the conversation you want to have. How do we get to some of this increase in virtue, especially when these young people that you're talking about entering that structure and those sets of incentives, they walk in the door and they might have an idea of reform and they might have an idea of something else, but they walk in the door, if they're going to stay, they're going to be playing by the house rules, aren't they?
Absolutely. Thinking about this, I want to be realistic. I am also in the industry, and my sense is that you have to be realistic about the fact that individual behavior is largely driven by incentives, and in turn, those incentives are shaped by market forces. It is not easy at all to diverge from industry norms and from short-term profit maximizing path. And that if you do, there are some serious personal trade-offs involved. You can't walk into Barclays or Morgan Stanley or any investment bank and then decide on your own to reshape the way they do things. In some ways, my advice to students is a few things. One is to be as good as you possibly can from a skill-based perspective, because that gives you credibility. It's very hard to try to change things without that credibility. But then it's about creating awareness and creating some transparency. And you can have a role in doing that.
What would be an example of the awareness? So if I'm listening to a critic in the audience who might be saying, oh, JC is being a little kumbaya there. What's awareness with Goldman Sachs and JP Morgan? They got their incentives, they got their structures. How do we get to that pivot where a little more virtue enters realistically?
I mean, I think practitioners, whether at Goldman or anywhere else, because you're so deeply embedded in a web of incredibly strong pressure and you have these incredible incentives, you tend to, in some ways, be oblivious to either the indirect consequences or the side effects or the implications of some of your actions. So as a result, you don't necessarily question industry norms. At a very simple level, it might be having a conversation about, wait, we're going to invest in this, or we're going to support that particular we're going to offer that particular financial product, asking questions about what's the impact on this constituency or that constituency. Maybe it's as simple as asking questions, because the challenge is not about, I think, finance professionals knowing that they're extracting value from society, but at times not being aware of it. And I think having the conversation and bringing it up can be incredibly helpful and can, in and of itself, challenge people to rethink things.
You talk about some examples of established funds that have investment restrictions. They could be vice restrictions, environmental restrictions, whatnot, on what they invest in. Now, that's an interesting conundrum challenge as well, too, because ultimately, in this space of finance, peer competition, looking at each other, is the whole game. So if you, not you, but you out there, rhetorical, if you say, well, I want to go down a more virtuous path, I really don't want to have tobacco products or whatnot in my portfolio. I mean, in this day and age where people are looking at every piece of return, if something gets left out, I mean, it becomes very difficult to make those decisions when you know there's going to be untold numbers of funds, your neighbor funds, who will not make the decision to do anything except pursue 100% profit.
Yeah, you're absolutely right. The most important is that you have a customer mandate that you need to fulfill. And the customer mandate is about maximizing your returns given a certain level of risk. This point about screening out sin stocks or making sure that you don't invest in certain areas, that has its roots in, I think, the old approach to ethical investing. It was referred to as socially responsible investments. And that's a really challenging one because at the end of the day, if you take that approach, you end up, I mean, to your point, you often end up hurting yourself because unless the rest of the field is looking at it the same way you are, you just simply end up allowing people to come into these stocks at lower levels and you're not having much impact. What is fascinating from my perspective is the whole ESG movement has morphed in a way that is alpha generating now. In a sense, I mean, this whole point about embedding environmental, social, and governance factors. I mean, initially, there was this sense that it was about signaling your virtue, it was about perhaps doing good in the world. But what's interesting is that now there's a confluence of effects whereby it becomes a risk management tool and you can actually enhance your returns by adopting an ESG approach, particularly when it comes to climate, right?
You said right. And I can just think probably half the audience is going to agree on some climate issue and half the audience isn't.
Sure, yeah. Now, regardless of where you stand on climate change, I personally think it's hard not to do something about it, given how dramatic of a trend it is. There is realistically a high probability that new regulations are going to require companies to internalize the public costs of greenhouse emissions. To the extent that you can decarbonize your portfolio, what you're doing is you're positioning yourself well to generate excess returns relative to anyone else who's not decarbonizing their portfolio. Now, The caveat to this, of course, is how long is it going to take for these regulations to come about? They're coming about faster in Europe than in other parts of the world. But it's still the case that we're at a fascinating point in time when you could look at these portfolios and not only say, well, I want to do this because I think it's going to have a positive impact in the world, but on top of that, hey, it's actually going to likely generate excess returns.
And even if you disagree with the climate perspective that you stated, even if one disagreed, if you know that the other side of your opinion, the rhetorical opinion out there, if the other side of the opinion is, hey, we're going to be pushing for XYZ regulations and they're going to come at some speed regardless. I mean, even if you disagree with the climate hypothesis from a risk management standpoint, you have to consider that the other side is not giving up their side, their opinion.
Yes. I mean, the trend is moving in that direction. I mean, you can see the massive adoption of ESG has been staggering. It's a fascinating development.
Speak to the notion in trading and in finance. For the average person, they might not think about it, but at certain levels of finance, trading, investing, there is a good bit of deception and manipulation, and it's within the rules. So somebody on the outside might be looking at it immediately thinking, wow, that is really scummy behavior. But if you're in the shoes of the individual employing that behavior legally, and from their perspective, perhaps ethically, there could be really sound operational issues and competition issues on why they are using legal deception and legal manipulation.
Right. There are all sorts of examples of this. And there are a lot of situations in which you end up either deceiving the other side or manipulating the other side in ways that are completely legal, which will serve you well. It'll serve your customers well. In some ways, you're being successful in your primary mandate and your customer mandate by extracting value from the rest of society because you're impairing the integrity of markets. You're impairing the integrity of particular product that you're dealing with. So a good example are credit default swaps and the manufacturer defaults that we've seen over the last few years, where a number of hedge funds bought credit default swaps, ended up funding the companies to support their finances. But before they funded these companies, they asked them to voluntarily default on their debt in order for the funder, for the hedge fund, to benefit from CDS payout. That, of course, has triggered a frenzy of discussion. But when you step back from it, it's hard not to argue that it impairs the integrity of markets and that you're doing this, but in a way you're being a little bit of a free rider by taking advantage of the system. And in fact, I mean, the industry as a whole is moving towards trying to plugging that particular hole. But the challenge that I think Robert Shiller and George Akerlof put so well in their book, Fishing for Fools, is that it's not so much a bug of the system, it's very much inherent to the system where by definition, you're always going to find ways to find a loophole because you're motivated to do that. And the question is, if you're a well-intentioned finance professional, you want to serve your customers well, but you're also keen not to extract value from society, then you would probably think twice about pushing in that direction because it kind of speaks to the values that you care about and whether you care about being successful while supporting the collective interest versus being successful while extracting from the collective interest.
Let me see if I can piece together this final thought that I want you to give me your best insight on. So I can think back again, I've brought this up several times, fall of 2002, NASDAQ down 77%, get those interest rates down low, and that starts the real estate bubble. You've used the word unsustainable in this conversation. Give me some scenarios, not predictions, I'm not caring about that, but just give me some scenarios that you can imagine in our current world of no interest income for 10 years and stocks that seem to be rescued at any moment. There's a decrease by magic machinations that take place not in the market system, but behind closed doors at the Fed. Give me some scenarios about unsustainability, where we are today. Essentially, here we are in September 2020. Stocks are at all-time highs. Interest rates don't exist. What are some of the breaks that could possibly happen in your mind that might shock people?
One is that the capital markets, and particularly equity markets, end up not being a good indicator of prices and of value.
What do you mean by that? A bubble.
Yeah, like we get into an unsustainable bubble. And the challenge with bubbles is that by definition, they always burst. If the system conspires to kind of inflate the bubble and continuously inflate it because you want to prevent it from bursting, then the day of reckoning is going to be all that much greater. And you're going to have an epic crash at some point. The scenarios would be one, our capital markets are impaired because it's impossible to find prices that correlate with the value of a stock based on the future cash flows because everything is inflated. And that's problematic. And you see that in some markets that are rigged in a sense that don't function well. And the Chinese market for many years had these characteristics where a lot of the market ends up being driven by momentum more than by fundamentals. And you lose an incredibly important tool for your economy to function well. And to your point, you end up inflating a bubble forever, but it's never forever. And there's a point at which you have an epic crash.
I think that's the way that even if people don't understand finance as much as you do, I think instinctively they have that feeling. But the longer we move on from March of 2009, the longer we move on from March of 2020, I mean, look how epic. I mean, there's no way if market forces were allowed to just play out, March of 2020 was not going to just turn around. I mean, it was like March of 2020 goes into a tailspin, and then all of a sudden, something happens. Maybe you know a lot more than me, but something happens in the back rooms of the Fed, perhaps in coordination with the executive branch and congressional whatnot. And then all of a sudden, we're off to the races. I think the average person probably just looks at it and says, I cannot afford to not be on this thing because everything else in my life looks pretty rough. This is the only thing I've got because maybe my house is not really jumping up. Maybe I don't have a job anymore. I mean, most people really don't have investments in the stock market. A lot of people don't. It's a really fascinating point when you start to say it's impossible to find value. I mean, look, I'm a guy that's written quant books, but I know that if I've got somebody like you saying it's impossible to find value, that should cause most people to kind of like perk up and go, ooh, that's not a good thing to hear. Not from someone who's been studying finance and teaching finance for a long time. It's not a good thing to hear you say it's impossible to find value.
I don't want to overstate it. Of course, you can find value in pockets that have become out of fashion, but the trend is towards making it harder and harder. And there's something unsustainable in this, in my view.
It's a fascinating time. We'll have to reconnect in a year or two and see if any kind of dust is settled in one way or the other, or perhaps we'll be at negative 5% interest rates and the Dow will double from here. Who knows, right? The book, Seeking Virtue in Finance, Contributing to Society in a Confused Industry. It's a challenging topic. I'm guessing that a lot of your effort here is to start the conversation, get people talking. You already realize that you're up against a big wall. Sometimes that's where the opportunity is. If a lot of people are not pushing on the wall and one person starts pushing, that gathers attention, right?
Yes. I want to say, to your point, I want to be realistic, and I'm not professing to offer a comprehensive solution to the role of finance in society. All I'm saying is that I think we can learn from studying role models in the industry, and that could inform our own behavior.
By the way, is there anything I said today that where you really were like, oh, wow, because you're a nice guy, but where you said, oh, wow, Mike is a little off to the side. I'm just curious. Was there anything I said? I can take the criticism. Was there anything that caused you to feel a little bit like, oh, I don't know, that's not the exact way? Or did you feel like the conversation, we were pretty much thinking in trying to tackle this subject that we were both kind of thinking in the same direction?
No, not at all. I think you're rightly also focused on how people might look at a rising stock market. And some people are going to look at this as a lifeline and they're going to see this positively. And you're absolutely right, particularly in the US, where so much of people's savings are in the stock market. I mean, if this were Japan, you wouldn't necessarily have the same reaction because so little of the savings are in the stock market. But in the US, the stock market is so central to our society. Yeah.
And how different could this conversation be, for example, if the Dow was down 50% from here? We would probably have a little bit different tone in how we tackle this issue, because you are laying out a scenario where you think, okay, not sustainable. At some point in time, things need to come down. I'm not putting words in your mouth, but I mean, it is an interesting conversation in the sense that maybe people don't pay attention as much when things are at all-time highs.
Yeah, if the S&P was down 40%, then you'd think really hard about what can we do to boost the market. But two, now let's invest. There's so many opportunities because we have faith in the system. We have faith in our capitalistic market. And then the whole conversation would be about, okay, how to get capital into all these opportunities that are presenting themselves to bolster the system and to bolster the economy.
I'll let you run, but what I love about this conversation too is it is an interesting one in the sense that you can get partisan divide pretty quickly. And I don't think we really did that today. I think we stayed kind of an objective, trying to look from a neutral standpoint. I think so much today, people are so divided on things that they need to hear a neutral, objective perspective, an educated, neutral, objective perspective, and not just immediately assume whoever's talking might have a partisan pole they're sitting at. Whereas I don't think we talked about things today that really went that direction.
No, I don't think so. And particularly because a lot of the conversation was focused on behavioral aspects rather than the regulatory perspective, which hasn't been really my focus. Now, the other piece too is that I think it's less natural to have a partisan discussion if you think of it on a global basis, because if you look at markets in Asia, for instance, the dynamics are very different. There are all sorts of discussions you could have on, say, for instance, shareholder versus stakeholder approach to capitalism. And here my answer would be different depending on whether you're talking about the US versus Germany versus Japan. It all depends on where you are.
Again, the book, Seeking Virtue in Finance, Contributing to Society in a Conflicted Industry. Where can we send people? Do you have a web page, or beyond buying the book, checking that out at Amazon? Is there anywhere you want to send people?
My Princeton webpage is probably the best. I think it's scholar.princeton.edu/JC or just Google me and it will come up.
Hey, thank you for taking the time today. Fun conversation. I took you in all kinds of directions. I don't know if you were prepared for where I was going to go, but I'm often not prepared from where I'm going to go. I want to feel where you're coming from and then just start exploring. So I appreciate you coming on.
Great. Well, thanks so much. I really appreciate it. I enjoyed it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.